Afternoon, ladies and gents. It's Simon Brown here doing the introduction today for Warren Peacock. Warren today is going to be chatting around how to build a trading plan. And it is critically important. I talk about it lots. It's not just about, getting the moving averages right or the technical analysis part. There's a lot more to the trading plan than just that. Warren will be delving into. It's probably going to be maybe 15 or 20 minutes or so from Warren. We've got time for questions. Certainly, if you've got questions as they come up, pop them into the question box on the GoToWebinar application. And if they're critical, we take them then. I'll button and post them to Warren. Otherwise, we'll take them at the end of the presentation. Warren, let me hand over to you.
Good afternoon, everybody. Today we're going to be looking at how to build a trading plan. We're going to get straight down to it. Many traders only have an idea of how they want to execute their trades. And that leads to trader error and is a costly exercise. If you just have an idea, then you do not have a plan, you have a wish. And of course, wishes cost money. It's one thing to know which indicators you want to use. It's another thing to know how exactly you want to use them. So you do need to know everything about your trade before you actually enter a position. Oh, I'm stuck this side. Yeah. I've put 5 points together for a basic trading plan. If you follow those 5 points and you fill them in, you will have perspective on your trading ideas. Point number 1, money and position management rules. Point number 2, which indicators are you going to use? Point number 3, trade setups. And that is just the idea about which direction is probable. And then trade triggers. Those tell you to trade now. And then, of course, the all-important exit strategy. Once a trade is complete, the idea is to analyze the execution of the plan rather than just looking at your profit and loss per trade. Trading is about accumulating higher profits than you lose when you're wrong. So analyze the plan, make sure that you are following the plan. If the plan needs to be tweaked and changed, then that's what you need to do. But you can't know that unless you actually go and analyze the whole thing. So we're going to go a little bit now and have a look at the points one at a time. I'm not going to delve into the absolute detail of the actual systems and strategies. This is just an idea for you to plug in your trading plan. You can take your indicators, put them together, answer those 5 questions. Hopefully after this webinar you have a good idea how to do that. You are welcome to email me and I will send you a little Excel spreadsheet that has a basic outline for you to fill in. And then as part of the webinar, you could just send that to me. I'll have a look at it for you and give any comment if necessary. So we start with point number 1, money and position management. Those of you that know me will know that's probably the most important thing in my idea about trading and teaching people to trade. If you can manage this, then you'll be okay. I've just worked on an account size of 100,000 Rand. And the rule is exposure per share trade, 50,000 Rand. Stop loss, 2% of account capital. Now you can fill in more detail there, so you could add in maximum 3 trades or maximum 2 trades, or you want to change the size of those positions. But under point 1 is where you put in all the money management and the position sizing stuff that you're going to need to make your trade. And the reason you do this is that when a signal does come, you don't have to think about how many shares I need to buy. You can have done all the work up front. Point number 2, which indicators are you using? Just chucked in a few indicators here. Exponential on DMA of 89 periods, 9 MACD, and candle patterns. So these are all the indicators that you use. Now remember, different trading systems will have different indicators. Each system should be separated. I'll cover that in a little bit more detail later on. Those indicators will give you trade setups and triggers. You have to define the difference. So on point number 3, we just put in the setups. Now remember that this is the idea of which direction is probable. So under this point, we're going to fill in how we determine trend. I've just used simple moving averages. 21 exponential average is above the 89 exponential average on a weekly chart. You then consider the trend up. 21 is below the 89, you can consider the trend down. Then we go into the actual trading side of things. You can look at the daily charts. We want to trade in the direction of the weekly trend in this example. I've got three setups here. Setup A, on the daily chart, if the 21 crosses above the 89 and the price returns to the 89, you get ready to buy. And this is only if the weekly trend is up. When the 21 crosses below the 89, price returns to the 89, you get ready to short if the weekly trend is down. And that's basically just for this example. Setup B, 21 is above the 89, so my trend is up on the daily chart. The MACD returns to 0 and finds support, and I get ready to go long. 21 is below the 89, MACD will obviously be lower, so it'll come back to 0, finds resistance at the 0 line, now get ready to short it. Setup C, price finds support, remember just your horizontal support lines, looking to go long. Price finds resistance at a higher level, you're looking to go short. Now remember, these are just setups. So the setup tells me that I should be looking to go in one or other direction. From the setup, we can go and have a look at triggers. Setup A. Now remember, setup A was the moving average. I have the 21 above the 89. I have price returning to the average. I want to see a candle pattern on that 89 as a support level. And I've just chosen two particular candle patterns for the setup. A morning star off the 89 or a bullish hammer for longs. In other words, if prices come back to the 89, I get a morning star, I want to go long, or if I get a hammer, I want to go long. And I'm only looking for those two candle patterns at that level. On the short side, I want the price to come back to the 89. I want an evening star or a shooting star for a short. Remember, these are triggers. When that candle pattern occurs after the setup has happened, this is your trigger to make the trade. For setup B, MACD crosses its trigger line in the expected direction. So what we have in setup B, we've got 21 above 89, so we are looking for longs. The MACD has gone from an overbought position, has now returned to the 0 line. Once it crosses its trigger line, in other words, the MACD's moving average, that's the trigger to trade. So it's found support on 0, it's crossed above its moving average, that is my trigger to enter the trade. For setup C, candle patterns at support. And here I've thrown in a few extra ones because I have a little bit more flexibility on trading setup C. Morning stars on support, bullish engulfing on support, or harami on support. And you can add in there any other candle pattern that you consider important. For the bearish side of things, I'm looking for candle patterns at resistance. So I want an evening star, bearish engulfing, or a bearish harami, telling me that I should enter the short now. Ideally, what you want is each of these setups must be in separate trading plans so that you do not get crossover on your trading systems. And yes, that does mean that you end up with quite a number of trading plans, but the idea is that you can choose which one you're going to trade. So if you decide that the MACD is starting to look like it's going to give me a trade, then you can pull out your trading plan for MACD and you can go and refresh your trading system. Point number 5, exit strategy. And here we've got a couple of options. Stop loss, maximum 2% of capital. So in this example, if 100,000 Rand account, it would be a 2,000 Rand stop. Target, in other words, my profit take, 3 times my stop loss, or 6,000 Rand in this example. That is just one way to exercise my limits. In other words, my profit limit. On setup A, what I did now is I just put in some rules to take profits. On setup A, once the profit exceeds 2% of capital, in other words, I'm 2% of capital in a profit, I move the stop to entry, and then only exit if price closes, if I'm long, closes below the 21 MA in the opposite direction of my trade. So I'm long, the price closes below the 21, I'm out of there. The opposite is true if I'm short. then the same thing applies. I'll hold the trade. Once I'm up 2% on capital, move the stop to entry, and then exit if the price closes above the 21 MA. For setup B, the MACD. The MACD crosses its trigger line in the opposite direction. So remember, we had the trigger. MACD trigger told us to buy once it crossed its trigger line after bouncing off zero. It's now gone up and up and up and up and up. MACD turns over, crosses down through its signal line. I can exit the trade. For setup C, price closes above or below the candle pattern in the opposite direction. So that's my stop loss. Or it goes, let's say I buy off support, it goes to resistance, gives me a bearish candle pattern at resistance. I can exit at a profit there. Stop loss is when the price goes below the candle pattern that I traded. Each of those must be calculated based on your money management rules. So if you have a maximum of 3% loss, then make sure before you enter the trade that if it does go against you, your stop loss maximum is not going to be violated. I don't know why I've got a delay here. All right, here's an example of a trade setup and the trigger occurring. I did zoom in, so just bear with me a little bit here. We've got a support line was broken in history. This blue line, the horizontal blue line, it was broken and price came back, was finding resistance, finding resistance, finding resistance. It then broke away and it has since pulled back and gone back to that old support line, which is now resistance. It has also returned to the MA2, which was my setup A. And then I had a shooting star candle trigger the trade entry. On the right-hand side of the chart, you can see a little beginning of a risk-reward calculation. The entry is somewhere in that white candle. The stop loss is put above the candle pattern. And that also happens to be above the resistance level. So your stop is nicely in place. Make sure that it is less than 2,000 Rand. Execution of the trade. Once you see that, you don't have to think anymore. You know exactly how many shares you need to sell. In this case, we sold 50,000 Rand worth of those shares. The stop loss is at 2,000 Rand, in this case just above the candle pattern. And for this trade, we used a 3 times the stop loss for a profit target. So it would be a 6,000 Rand profit versus a 2,000 Rand loss, which gives me a nice little risk reward of 1 to 3. Sorry, I put in here 1 to 6 typing error. It's a risk reward of 1 to 3. And here's the completion of the trade. On the top, we had the candle pattern, trigger at resistance. The price came off. It then returned. Notice that the stop loss was not violated. In this particular example, we just waited for the target to be hit of 6,000 Rand, and that gave me the risk reward. So it's straightforward, not too much thinking. You can just make your trade and not worry about anything. You don't have to think while you're in the trade. Everything is done beforehand. It was quite a lot of stuff for one trading plan. What I did on the next slide is I just put together a simple trading plan, and this is sort of what your trading plans will look like for every trading system that you use. I've just used a MACD hook trade in this example. Remember, each trading setup has a different set of rules. So what we've done here is I've just put in point number 1, trading 2 contracts. That's my position management. The indicator I'm using is a MACD, 1226.9. Point number 3, how does the trade set up? I get a hook trade on a 10-minute chart. Number 4 is explaining the trade. The MACD comes from an overbought area, crosses below its trigger, which is the 9 MA. The MACD then returns to that moving average. The small break is okay, and then breaks down a second time. Once it's closed down for one period, I enter the short. And that's it. I don't need to think. I can just read it, look at it, see what's happening on the chart, confirm it. It's closed down one period, enter the trade. and obviously the opposite for the long. The MACD goes from an oversold area, crosses up through its trigger line, returns to the trigger line, a small break is okay. It then breaks up again for one period, and we enter the long. The 100-point stop loss, this is now my exit strategy, should be point number 5. 100-point stop for both contracts. In other words, once I've entered the trade, I can just have a stop loss at 100 points. First contract, which, by the way, doesn't violate the 2,000 Rand stop loss that we require against account capital. First contract is closed at 100 points profit. The second contract, stop is moved to entry. So once you've banked 100 points, second contract is moved to entry as a stop loss. In other words, I guarantee myself the 100 points. And the second contract is exited when the MACD crosses its signal line. Now remember, this isn't about trading strategies, it's more about a trading plan. So when we move on to the picture, it's nicely illustrated. We have the MACD from a slightly overbought position, it breaks its signal line, it comes back, it breaks above. 2 or 3 periods is okay, it closes down 1 period. The first vertical white line is the entry point. The first horizontal line is the exit at 100 points, so the first contract is exited at 100 points. The second contract stop loss is moved to entry, and the second contract is closed once the MACD ends up 1 period through its trigger line. This example just returned 190 points. All it's meant to illustrate is that if you have a plan, it is easy to then just execute. You don't need to think while you're in a trade. You don't need to think before the trade. All you need to notice is the setup. So the bottom line is a plan allows you to trade without thinking too much. Trading must be a clear, straightforward system. That doesn't mean that you're rigid, okay, because these plans can change. The market changes, volatility changes. When we did something a little while back on the ALSI, you were lucky if you were getting 80 points a trade, and these days it's gone up to over 100 points a trade. So markets do change, and your trading plan is allowed to change with it. Beware not to change your trading plan while you are in the middle of a trade. You follow the rules until complete. Guys, thank you. I hope that was informative. I did put a discount together for those of you that are watching the webinar. It is valid until the 1st of December. I'm just offering a 75% discount on a 1-month coaching session, and that'll allow you to send me through your trading plans. We analyze it, we go through your systems, and make sure that you've got everything in the right order. You're welcome to contact me to ask me questions about this, about the webinar. Thank you, Simon.
Warren, thanks very much. And a couple of folks said, how do we email Warren? Well, there's the trick, warren@thetradersplace.co.za, nice and simple. Folks, if you've got questions, pop them into the question box on the GoToWebinar application. We'll take them. A couple coming through. Clifford was asking about different trading accounts, and I do it within my stockbroker. I think I've got 7 or 8 different accounts. And the point that he was making is, do you pay extra? Certainly in my case, my broker doesn't charge extra. And I do as Warren says, every strategy I trade has a different account that I trade it in, so that it's nice, it's clear, it's defined, it's easy to measure. I know what my entries and exits and thinking is for each of those particular ones. Warren, the other question that came through from a couple of folks on that ALSI trade, you mentioned a hook trade, and folks are saying, what is a hook trade? Yeah, you saw that coming, didn't you?
As defined on the rules there. So, if you go back and have a look at that, the slide, it's just simply where the MACD has crossed down through its signal line. It then returned to the signal line. Sometimes it'll cross it by 1 or 2 periods. But in this example, it crossed it, I think, for 2 periods. It crosses down through its signal line again, and that's considered a hook trade. Ideally, what you want is the MACD to be heavily overbought or heavily oversold, and that second just touches the moving average.
Gotcha.
And that would be a hook trade.
And then a question coming through, and coming from Chantal. She says, how many systems could one conceivably trade? And I think it's a great question, and I'm not sure. I mean, I suppose it depends, A, on your capital, and B, how much you can focus. I typically trade 2 or 3, maybe 4, but some of them are quite lazy systems and only generate a dozen a year. I suppose it depends on time and capital. Warren, comments on that?
Yeah, I agree with you. Obviously, capital is a big one. You can split your account up into smaller pieces if you've got enough cash to start with. The other thing is, over time, you build so many systems that you end up crossing them over. So firstly, define each system, and you can have 30 trading systems, and then you're almost guaranteed, at least a trade a day on an intraday basis, or a trade a week if you're trading end of day. Having that many systems, though, does leave you open for error. So define them, and each one has a different setup. Today might not give me a MACD trade, but it could give me a support resistance breakout, or could give me a chart pattern trade. So you can have as many systems as you want, just don't trade them all at the same time.
Yeah, and make them different enough. I mean, I differentiate sometimes between intraday and end of day, and they're all kind of trendy-based systems. I don't typically do swing or breakouts, but I hear your point there. Fair shout. Another question coming through is 2%? Can you try that again? Is it possible to even have less than 2% at risk? And I suppose the answer is yes, but you're got to be careful you don't get stopped out too easily.
I think it depends what you're trading. If you're trading Forex, then you can easily have 0.02% or something of an account. It really depends on account balance. Because for some people, 1,000 Rand might sound great at 2%, when in fact you should actually only have a 200 Rand stock.
Yeah.
So it does depend which market you're trading. Stocks, it's sometimes difficult to have 2%. Only 2%, because the stock can move quite a lot in a day, and stop you out on 2% at 2.5%, and then continue in direction. So I think the answer is really it depends on account balance and which market you're trading.
Yeah, that's a good shot, and it is about market and I suppose in a sense of volatility or efficiency of that market. I trade ALSI futures, and they can be as fast as all heck. A question, okay, they're asking for the email address. It's there. I'm not seeing any more questions coming through, so ladies and gents, we'll leave it there. Warren, my thanks to you for the presentation. I think it was great. I think it's critically important we understand that it is more than just looking at the chart, that there's a lot more to it than just that. And ladies and gents, to you all for attending this afternoon, thanks very much for your time. Cheers all.
Thank you, Simon. Bye-bye.